We're going to do chapter 6. It's on variable costing, segment reporting as well. We're going to compare variable costing and absorption costing. We'll work through an example to show you the difference between the two. And before we do that, though, let's talk about the schedule. So let me pull that up real quick. So on Canvas, under the class, you'll have a revised schedule. That's the one that you need to follow because we changed some things last week so that I could, or 2 weeks ago, so that I could have the nights that I needed to take off for the open houses for high school because they're all on Thursday nights. So last week we had the test, and I will be putting up an extra credit assignment, probably open for this weekend, and then it'll be open for a little bit if you are wanting to get a couple of extra points on that exam too. That will be available this weekend to get started with that. And we did chapter 5 2 weeks ago, so that recording is up on the YouTube channel. And then tonight we're going to do chapter 6. So the next exam, exam 3, is only on those two chapters, chapter 5 and chapter 6. So the link that says revised schedule, if you open that up, I think this was the class that had the blank. Yeah, it's fixed. Okay. So we are in the week of October 16th. So today, the 19th, we are doing chapter 6. Next week on, let's see what the date is on Thursday. I think it's the 26th.
Yes, 26th.
Okay, the 26th, we are scheduled for chapter 7. I may have to move that because I have something going on with work on that day. So I'm going to have to shoot an email of how I'm going to change that up. But on the next week, the week of November 2nd, so it starts October 30th. That Monday is October 30th. So the exam's going to open up on the 2nd of November, and it'll be open all the way through the 5th, which is Sunday. So the 2nd through the 5th will be the exam. Next week, we may have an off week, and I'll probably combine 2 chapters together before we have that Thanksgiving break for one of the nights. So I'll look and see which ones I want to combine, because one of the chapters isn't as difficult as some of the stuff we're doing right now. So I'll look at that. So for now, we're doing chapter 7 lecture tonight. We already did 6. Those are the only 2 chapters on the test. That is going to be the week of October 30th. So it's going to open on Thursday, November 2nd. Next week, we're probably going to have off on the 26th. But I'll send an email to let you know for sure. Okay, any questions about the schedule?
So I just want to reconfirm. So the test 3 is on chapter 5 and 6, and it's open November 2nd through the 5th.
Correct.
Okay. Thank you.
Okay, so we're going to go ahead and get started with chapter 6. We're going to get started. Okay, there it goes. Okay, so first we're going to explain how variable costing differs from absorption costing and compare the two. We're going to compute the unit cost under each method so you can see how it works out and how it compares on the financial statements, and how it works through. We're going to actually do 2 years so you can see how it works through on the differences. Okay, so for this chapter, we're using actual costing rather than normal costing approach that was used in the job order costing chapters. So instead of looking at that predetermined overhead rate, we're actually using actual costing. We're going to use the actual number of units produced as the allocation base for assigning actual fixed manufacturing overhead costs to the products. So we're using the actual number that's produced. So what was the production for the period? And you'll see what I'm talking about when we go through the example. And then we're going to assume that the variable manufacturing cost per unit and the total fixed manufacturing overhead cost per period remain constant. So we're going to use the same numbers. We're not changing that. It's remaining constant. All right. So this is a good slide that helps you remember and can help you through the homework problems. Variable costing versus the absorption costing. So we break out our product cost and then we have our period cost. So we talked about our product cost, and what we've been focusing on the whole semester so far is that direct material, direct labor, and our manufacturing overhead. And that was all brought into the product cost. Then we had our period cost, like our selling and administrative expenses. So that is our variable costing. So, I mean, how we've been doing our costing so far through our job costing system. So when we're looking at variable costing, it's going to be a little bit different. So if you look at the product cost for variable costing, it's going to be the direct materials, direct labor. That doesn't change, but we're going to pull in only the variable manufacturing overhead. Okay, so not all of the manufacturing overhead. We're going to pull in the variable manufacturing overhead. The fixed part of the manufacturing overhead is going to be part of our period cost. So the only thing that's sticking to the product is direct materials, direct labor, and variable manufacturing overhead. Period cost is going to be fixed manufacturing overhead. It will be the fixed and the variable selling and administrative expenses. The absorption costing, our product costs were direct materials, direct labor, and all of the manufacturing overhead, and then all of the selling and administrative expenses, all of that was part of the period cost. So keep that slide in mind as we go through our examples. Okay, so which method will produce the highest values for work in process and finished good inventories? So is it absorption costing, variable costing? They produce the same values for these inventories, or it depends. So when I tell you that the product cost, the way that it's getting broken out, under absorption costing, all of the manufacturing overhead is going to tack on to the product cost. In variable costing, only part of the manufacturing overhead is going to stick to the product cost. The fixed portion is going to go into period cost. When we talk about work in process and finished goods, that is our product that is on our balance sheet. So they want to know which method will produce the highest value for that ending inventory and the work in process or the finished goods, things that are still in the process, either of, trying to get completed because they are in the middle of a period where they have some work in process. So they only have they have some stuff left on them. The finished goods is after they come out of that work in process and they're a completed good that you can sell. That's your finished goods. So which one do you think that is? Anybody want to take a guess?
The absorption
Costing. That's correct, because you have all of the manufacturing overhead that is attached to the product cost. It's not going to be expensed in the period, so it's going to stick with it. So if you have some of those products still in work in process, or some of the products still left in finished goods, you haven't sold it yet, it can cause it to be a higher value. So A. All right, so let's look at this example. Harvey Company produces a single product with the following information. The number of units produced annually are 25,000. Our variable cost per unit. So we have our direct materials, direct labor, and variable manufacturing overhead is $10. Our variable selling and administrative expense is $3. And then they give us our fixed costs per year as a total. So we have our manufacturing overhead at 150,000 and selling and administrative expenses at 100,000. So remember, you know, I said try to keep in mind that slide that we looked at that kind of breaks everything down for you. So remember that we need to know how to break out the variable and the fixed part of the selling and administrative expenses. And we also need to have our variable and our fixed manufacturing overhead separated, because part of it for variable costing is going to be part of the product and part of it's going to be part of the period. So that's why they have it split up this way. Okay, so when we want per unit, the way that we're going to calculate the per unit on the fixed cost. So the manufacturing overhead is 150,000. We have that 25,000 units that we produced. That's the number we're going to use to take the 150,000 and divide by the 25,000. So you're looking to see what was produced, and that's what number you're going to use when you're trying to figure out that per unit cost. So on this sheet, you'll see how they did that. So we have our direct material, direct labor, and our variable manufacturing overhead. That is the only product cost we have in variable cost. So that's $10. Then for absorption costing, we also have to include that fixed manufacturing overhead. So we take the 150,000 that was given to us, divide it by the 25,000 units, and we get $6. So there's your difference right there. We have that extra $6 in the absorption costing. All right, so under absorption costing, all production costs, variable and fixed, are included when determining unit product cost. Under variable costing, only the variable production costs are included in the product's cost. Okay. So now we're going to look at the income statements using both variable and the absorption costing so you can see the difference. So we're going to assume that they have 20,000 units that were sold during the year at a price of $30. We have to have our revenue in order to complete an income statement. So we have 20,000 units that we sold at $30. We didn't have any beginning inventory. Remember, we produced 25,000, so we had enough on hand that we produced this year in order to sell 20,000. All right, so under variable costing, so we're selling 20,000 units at $30. That's 600,000. Then we're going to take away our variable expenses. So our variable cost of goods sold was $10. That came off the chart that we have. Remember, that's the direct materials, direct labor, and the variable manufacturing overhead. That is, that's where the $10 comes from. So we take the 10 times the 20,000 units, we get 200,000. Then we have our variable selling and admin, which is $3. That was given to us on a couple of slides back. It told us that variable selling and administrative costs. Let's see if I can get back to that. Right here on this slide. That's where the $3 is coming from. It says variable selling and administrative expenses. I just want you to have that in case, just in case you need to go back to the slides and want to know where the number is coming from. Okay, so that's 60,000. So we have a total variable expense of 260,000. We deduct that from our selling price. So the contribution margin is 340,000. Less our fixed expenses, which are fixed manufacturing overhead and fixed selling and administrative. So we have 150,000 and we have 100,000. So we need to deduct that from the contribution margin to come up with the net operating income of 90,000. So let's look at absorption costing. So we're doing the same thing for sales, 20,000 times 30. Our cost of goods sold is 20,000 times 16. This goes back to the slide that we looked at that showed direct materials, direct labor, variable manufacturing overhead is $10. And remember, we had to calculate the fixed manufacturing overhead. The total was 150,000. We had to divide it by the unit of production, which was 25,000 units. That's where the $6 comes from. So our unit product cost is $16 under absorption costing. So we have our 20,000 units that we sold times the $16, which is 320,000. So now we have a gross margin of 280,000. Then we need to deduct our selling and administrative expenses. So we have our variable and our fixed. So the variable was given to us on the slide that we just looked at $3. That's 60,000. And then we have our fixed. The fixed cost of the selling and administrative expenses was 100,000 for the total. So our total selling and administrative expenses is 160,000. We deduct that from the gross margin, and our net operating income is 120,000. Now they're making a note at the bottom. The fixed manufacturing overhead deferred in inventory is 5,000 units times 6. So remember, we're including the $6 is calculated based on the total fixed cost divided by the units that we produced. That was the 25,000. That's where the $6 came from. We produced 25,000 in our period, but we only sold 20. That's where the 5,000 left in inventory is coming from. Okay, so what's left in inventory in that ending balance, it would be the 5,000 times the $6. So that's not included in our total. It's staying with the product. All right, so let's reconcile it. Okay, so first column's our cost of goods sold. So we have variable manufacturing expenses at 200,000. We have fixed manufacturing expense at 120,000. And then for the ending inventory, our variable manufacturing expenses 50,000. Our fixed manufacturing expenses is 30,000. Then we have under variable costing, we have all of the fixed, that's a period expense. So we're going to look at the variable expense, 200,000. We're going to have ending inventory of 50,000. We don't have any fixed manufacturing expense in the cost of goods sold or ending inventory because we used all of those as period costs. All the fixed is under period costs when it comes to the variable costing. So the period expense is 150,000. Okay, so if we look at our totals, we have total 250. We have the 150 for manufacturing expenses. So the totals are 400 each. But you can see that some 30,000 of that fixed is left in the inventory. So when we looked at the income statement for that variable costing, it was like 90,000. So we're going to reconcile that back. So when we had that net operating income of 90,000, that included all the fixed costs. So if we want to get back to the absorption cost, and remember a portion of it, we had 5,000 units times 6 that stayed with the inventory. So we're going to add that back in so we can reconcile it. So we have our fixed manufacturing overhead cost that's deferred into inventory, 5,000 times $6 per unit. That's our 30,000. So when you add them together, you come up with the net operating income on the absorption costing. Okay, so the absorption costing showed we had a little more in net operating income than under variable costs because a portion of those fixed expenses went and stayed with the inventory that wasn't sold. Okay, so let's look at year 2. So we're gonna produce another 25,000 units. This time we're selling 30,000 units. So we're selling more, but remember the previous year, we only sold 20,000 of our 25,000. So we had beginning inventory of 5,000. So then if you have 5,000 rolling into the new year, you produce 25,000. Now you have 30,000 available to sell, and we sold them all. Our unit price stays the same, 30. All of our variable costs stay the same. We have the $10 and the $3. And then our fixed costs are the same. We're not changing anything. It's remaining constant. So we just divide by the 25,000. That's how we got the cost per unit. To come up with this calculation here for our absorption costing and our variable costing, remember, we got to put that fixed manufacturing overhead in because that's part of the product cost. All right. So now we have 30,000 units sold. So we're going to take 30,000 times $30. That's our selling price to come up with the 900,000. We'll have variable cost of goods sold at $10. So 30,000 units times $10 is 300. We had our variable selling and administrative expenses, 30,000 times $3. So that's 90,000. Total variable expense of 390,000. We deduct that from our revenue to come up with the contribution margin, and that's 510,000. Less our fixed expenses, the total. So we had 150 fixed manufacturing overhead, and we had 100,000 of fixed selling and administrative expenses for 250,000 total. We deduct that from the 510, and our net operating income is 260,000. Under absorption costing, doing the same thing for revenue, 30,000 times 30. Cost of goods sold, we sold 30,000 units. We're multiplying it by the 16 because we're including that $6, which is the fixed manufacturing overhead. All right, so that's 480,000 total. A gross margin, we deduct that from the 900, gives us 420,000. Then we want to deduct the selling and administrative expenses. So we have our variable, which is 30,000 times 3, and we have our fixed at 100,000. So we come up with 190,000. So the net operating income is 230,000. So our fixed manufacturing overhead released from inventory is 5,000 units times 6, which equals 30,000. So remember, we had that inventory and we had a part of the cost of the fixed manufacturing overhead stuck with the product cost. So now we're bringing that back in. So when we reconcile, we looked at the variable costing net operating income, which was 260,000. And then we need to deduct the fixed manufacturing overhead cost that came into year 2 because we sold those units. We need to deduct that out so we can reconcile back. So we're pulling out the 30,000. And the absorption cost net operating income was 230,000. So we reconcile back. All right, so here is how it played out for year 1 and year 2. So under absorption costing, we had 120,000 in year 1. Variable was only 90,000. But in year 2, the absorption costing, we had 230,000. And variable costing was higher at 260,000. So in the end, they both have 350,000. It's just the difference in the timing of when product was sold. All right, this is another slide that could be helpful when you're trying to think about how it's what effect it's having on the inventory. So if we have the same number of units being produced that are sold, so if they equal, then there's no change in inventory. There's no effect on that. If we have units produced greater than the units sold, well, part of that fixed manufacturing overhead is going to stick with some of that inventory. So your inventory number is going to increase. And the absorption is going to be greater than the variable. Okay. Then the year that we have units produced is less than the units sold, which was our second year example. Our inventory number is going to decrease because we're pulling out more than what we produced. So it's going to decrease, and our absorption costing is going to be less than the variable costing. So let's go back and look real quick at the slide. It shows you here. So here's the monies, and it's saying that the absorption cost is going to be greater than the variable cost. So our absorption cost here, like what our net operating income was, it's more than what the variable was. And then when we look at the units produced is less than sold, the absorption is going to be less than the variable. And so here's my income for absorption, 230,000, and it is less than the variable. Okay, so the table could kind of help explain what's going on just in a little snapshot. So this could be helpful when you're doing your homeworks. All right, so this is just basically saying because we assign part of that fixed cost to the unit produced, that's why you have those changes when it's in inventory and how it when it's produced, when you doing production more or less than what's actually being sold. That's what we just talked about. Okay, variable costing income is only affected by changes in unit sales. It's not affected by the number of units produced. So as a general rule, when sales go up, net operating income goes up and vice versa. Under absorption costing, income is influenced by the changes in unit sales and unit production. Net operating income can be increased simply by producing more units, even if those units are not sold. Variable costing correctly identifies the additional variable cost incurred to make one more unit. So $10 per unit in our example, it only emphasizes the impact of the total fixed cost on the products. And then because absorption cost and assigns fixed manufacturing cost to the units produced, which was the $6, it gives the impression that the fixed manufacturing overhead is variable with respect to the number of units produced, but it's not. The result can be inappropriate pricing decisions and product discontinuation decisions. So it seems like part of it's variable because it really depends on, you know, how many units you sold versus how many units were produced. And so that could lead to making a bad decision. All right, so now we want to look at segmented income. So we're going to prepare a segmented income statement. It differentiates traceable fixed costs from common fixed costs, and it's used to make decisions. So before we move on to that, do y'all have any questions on what we just went through and how to calculate the numbers on both methods? Is there any questions there?
No, not right now.
Okay. All right, so a segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. So it could be an individual store, a service center, a sales territory. So we'll walk through an example and help you understand that idea a little bit more. There are two keys to building a segmented income statement. So a contribution format should be used because it separates fixed from variable costs and it enables the calculation of the contribution margin. So remember, contribution margin is those sales minus variable expenses. And then we have traceable fixed costs, which should be separated from common fixed costs to enable the calculation of a segment margin. So a traceable fixed cost is something that you can trace to a particular part. Maybe it's that store, or maybe it's that particular product. Common are going to be fixed costs that you have regardless if you carry that particular product or regardless if you have that store. So those aren't going to change whether you sell it or not, or if you close one store versus, you know, having it open. Those costs are going to remain, those common costs. The traceable cost, those you can trace to a particular product or a particular store or something like that. So if you were to close that store, if you were to close that product line, then you would be able to get rid of those traceable costs that are associated with it. So we'll look at some examples that makes more sense. So traceable fixed costs arise because of the existence of a particular segment and would disappear over time if the segment itself disappeared. So examples. The salary of a Frito product manager at PepsiCo is traceable fixed cost to the Fritos business segment of PepsiCo. So we're paying him to oversee all the Frito production. If we didn't have the Frito production, we would not have that manager. So that particular cost would go away. Then we have the maintenance cost of a building in which Boeing 747s are assembled is traceable fixed cost to the 747 business segment of Boeing. So if they decided they're not going to build those 747s, then we wouldn't have that maintenance cost any longer because they wouldn't have that plane. Common fixed costs arise because of the overall operation of the company. They would not disappear if a particular segment were eliminated. So the CEO, the salary of the CEO of General Motors, it's a common fixed cost. So maybe they decide they're not going to sell, one product in their product line, but that doesn't mean that his salary goes away just because they're not producing that any longer. He's overseeing the entire company. So his salary will remain even if you get rid of one of those product lines. Or the cost of heating a Safeway or Kroger grocery store, it's a common fixed cost to the various departments. So maybe that grocery store has a bakery. Well, the cost isn't going to go away for our electricity on the, or heating up the store because we still have to do that. So that will remain even though we close the department. All right, it's important to realize that a traceable fixed cost of one segment may be a common fixed cost of another segment. For example, the landing fee paid to land an airplane at an airport is traceable to a particular flight, but it's not traceable to the first class, business class, or economy class passengers. So you have that flight, it's going to have a cost, but that isn't that's not going to go away if you stop selling first class and you just have business class for the whole plane. You're still going to have that fee for the plane. I think we went backwards. Hang on. Okay. The segment margin, which is computed by subtracting the traceable fixed cost of a segment from its contribution margin, is the best gauge of the long run profitability of a segment. So if you can separate out those traceable costs to that particular segment, then it helps you make decisions on if you're going to keep that product line or not. If you got rid of the product line and you were only able to get rid of a certain fixed cost, maybe it would be something that would hurt you overall, even though it looks like you're losing in that one particular segment. And we're gonna look at that in just a minute. All right, so we have a fixed cost. It could be traceable or it could be common. Those are the two that the fixed cost can be for the segment. Traceable is going to go with the segment. If it's common, it doesn't allocate to the segment. All right, so we have Weber Inc. They have two divisions, a computer division and a television division. Let's look more closely at the television division's income statement. All right, so we have sales of 300,000, variable cost of goods sold of 120,000. We have other variable expenses of 30,000. So a total variable expense is 150. We deduct that from the 300, and that gives us our contribution margin, which is 150,000. We have traceable fixed expenses of 90,000, and our division margin is 60,000. Okay, so we have fixed and variable costs that are listed in separate sections. So the contribution margin is computed by taking those sales minus the variable cost. That's just the formula you learned a couple of weeks ago. And then the segment margin is television's contribution to profits. So in this case, we have the division margin at 60,000. Okay, so here we have the company in the first column as a total. Then we have our two different segments. We have that television and then the computer. So under the television, we have the 60,000 division margin. And then they want to take the common expenses. We're going to deduct those out to come up with our net operating income. So a total, let's go back. Here we go. All right. So we have a total traceable fixed cost of 170,000, and 90,000 is for television, 80,000 is for computer. Then we have the common expenses of 25,000. It's making a little side note that the common fixed expenses should not be allocated to the divisions. They remain if one of those divisions is eliminated. So it's not, it's not going to go away. All right, so we have 160 of fixed, traceable fixed costs, and that's broken out 90/80. Okay, as previously mentioned, fixed expenses that are traceable to one segment can become common fixed expenses if the company is divided into smaller segments. All right, so let's look at our example. So in the television division, we have two product lines. We have regular and big screen. So for our sales, we're selling more regular than we are on big screen. We have our variable expenses in there. So our contribution margin for the regular is 105,000 and the big screen is 45,000. We have traceable fixed cost of 45,000 for regular and 35,000 for big screen. So you can see our margin under the regular 60,000 and big screen's 10,000. Common expenses are 10,000. So the total margin was 70,000 for both products. We deduct a 10 in common, we come up with 60,000. So we have 80,000 total traceable fixed costs. So at the bottom, it's showing you that the television division has 80 plus the 10,000, which is 90,000 total. Once a company prepares a contribution format segmented income statement, it can use the statement to make decisions and perform break-even analysis. Okay, so let's look at the income statement. All right, so we have our television division. We have our totals in the first column. And then we have our regular and our big screen. So we have traceable fixed cost of 80. We have that split 45 and 35. All right. We have common expenses of 15,000. We have division margin 62.5. So they're saying we have a 5% increase in sales. So if we increase those sales 5%, that gives us an additional advertising cost of 5,000. So we're adding that to our common. And then our margin increased on the regular TV with those increase in sales by 52.50. Okay, so then we deduct that traceable fixed cost out. So it gives us a product margin of 65,250. On the big screen, we have a margin increase of 22.50. We deduct out the 35,000. So we have 12,250 as our product line margin. All right, so now we're looking at both divisions again. So we have our total column first. We have our traceable fixed costs being broken out between the television and computer. We have our common expenses of 25,000. Those don't go away. So we have a net operating income of 75,000. So how do we calculate the break-even point? So the company-wide break-even point is computed by dividing the sum of the company's traceable fixed expenses and the common fixed expenses by the company's overall contribution margin. So we're just taking fixed cost divided by the contribution margin ratio. If you forgot how to calculate the contribution margin ratio, you have that in your notes from previous chapter, but on here it's showing you how to calculate that. So we have the 270,000 is our contribution margin, and we're dividing that by our total sales. Okay, so it's the contribution margin divided by the total sales, and we get 0.54. So when we do the break-even point, we're taking our fixed cost and dividing it by the overall contribution margin ratio. So we have our number of 361,000. All right, now let's look at it for each segment. We're going to do the same thing, but for each segment. Okay, so the contribution margin, we have 150,000 as a contribution margin for the television. We're dividing it by the 300,000 in sales that we had from the television to come up with 0.5. And then we take the traceable fixed costs for the television segment, which is 90,000, and we divide it by the 0.5. So we come up with 180,000. For the computer, we do the same thing. We find our contribution margin ratio first. So we take the 120,000, which is our contribution margin for the computer segment, divided by their sales of 200, and we get 0.6. So we're going to take our fixed cost of 80,000, which is traceable to that segment, 80,000 divided by the ratio, which is 0.6, to come up with the 133,333. All right, now it's just noting again the 25,000. So the 25,000 of common expenses, they're excluded from the segment break-even calculations because the common fixed expenses are not traceable to the segments. So they're just telling you, you know, if you have to figure out the break-even of a segment, you wouldn't bring in the common expenses because they're not going away. So if you're going to do it on the company-wide, you would have to include it. And then if you're doing the segments, you would not include it. Costs assigned to a segment should include all costs attributable to that segment from the company's entire value chain. Okay, so we have research and development, we have product design, manufacturing, marketing, distribution, and customer service. If we have a failure to trace costs directly, costs that can be traced directly to specific segments of a company should not be allocated to other segments. So you want to make sure that whatever cost you're trying to trace, it's appropriate for that segment. And then some companies allocate costs to segments using arbitrary basis. Costs should be allocated to segments only when the allocation base actually drives the cost being allocated. So if you're trying to calculate something and you're using an inappropriate allocation base, then your numbers, they're not going to be good when you're trying to do your calculations to make decisions, because maybe you allocate it too much or not enough, and you're trying to make a decision to get rid of a segment in a business. Well, then you have to make sure you're tracing the cost correctly, because if you don't, then you may be allocating to another segment. And if that inappropriate allocation base, it can throw things off. Common costs should not be arbitrarily allocated to segments based on the rationale that someone has to cover the common cost for two reasons. This practice may make a profitable business segment appear to be unprofitable, and allocating common fixed costs forces managers to be held accountable for costs they cannot control. So a lot of times, like I know, like at my husband's plant, they they have certain incentives based on different things that happen in the plant. And if you have costs that are not assigned correctly, then you have someone that's getting hit with something they have no control over. And so that's not good practice. And then, if you have a segment that looks unprofitable, then that's not good either. So in my company, we don't have segments like that. We have multiple properties because we're in real estate. So we have a lot of different properties across the board. Well, we have property managers that manage those properties. Sometimes that one manager is managing multiple properties. You have our accounting department, and that accounting department is supporting all of the properties. And so we have to come up with an allocation of how those costs are going to be assigned to each property, each location. And if we are not careful in how we allocate, it could be that a property that maybe doesn't bring in a lot of money, but it also doesn't have a whole lot of transaction. There's not a lot of time spent there. If there's too much allocation of the payroll from accounting and from management, then it's going to look like that property is unprofitable when that may not be the case. It's just not properly allocated the amount that it should be for management of that particular property. So you can look, you can have this issue where you have to allocate things, even if you're not working at a plan or have segments. If you're in real estate, that could be a problem. And so we are always looking and trying to evaluate how do we allocate all of our costs across our properties. Okay, assume that Hoagland's Lakeshore prepared its segmented income statement as shown. All right, so let's look at their traceable fixed costs. We have a total of 246,000. And we can break that out where the bar is 26,000 of those fixed costs and the restaurant is 220,000. Now, the restaurant's bringing a lot more revenue than the bar is. So the bar has a low segment margin of 14,000 versus the restaurant that has 230,000. But in addition to that, we also have 200,000 in common expenses that are not going away. So our profit's only 44,000. All right, how much of the common fixed expense of 200,000 can be avoided by eliminating the bar? So let's go back. So here's your sheet. So they want to know how much of those common expenses go away if we eliminate the bar. Somebody want to guess?
It would be none because they still have the rent and the electricity and all those expenses to pay, whether the bar's there or not for the restaurant.
Correct. Yeah. So the common fixed costs, remember, they don't go away. They are going to stay, and those are the ones that are sitting down here. So regardless if we have that bar or not, we're still going to have that 200 in the common fixed cost. So none of it goes away. All right, suppose square feet is used as the basis for allocating the common fixed expense of 200,000. How much would be allocated to the bar if it occupies 1,000 square feet of the restaurant, and the restaurant is 9,000 square feet? So we have 1,000 square feet over a total of 10,000 square feet, right? The bar is only 1,000 of the total, which is 10,000. So if you take 1,000 divided by 10,000, we get that 1/10 or that 10%. So the 200,000, let me get my pen. All right, so we have 200,000 times that 10%. So it's 20,000. So that's how much of the 200 common would be allocated to the bar if we were going to allocate those common expenses. And potentially, if we do that, they didn't have, remember, they only had 14,000 that they were making in that segment. So if we do that, that wouldn't be good. So if Hoagland allocates its common expenses to the bar and the restaurant, what would the reported profit of each segment be? So let me get rid of this annotation and then we will go to that screen. Okay. So let's see what it looks like. All right, so now right here, this common expenses, they're breaking it up. So they throw 20 more thousand onto the bar. And then they have another 180,000 on the restaurant. So it looks like the restaurant's at 50 and the bar is at 6,000. So we've taken that common and we're allocating it. So now it looks like we have a loss in that segment. All right, so do you think the bar should be eliminated? Yes or no?
No.
No. So the profit was 44,000 before eliminating the bar. If we eliminate the bar, then the profit drops down to 30,000. So we still have that 200,000 in common expenses because we don't lose it. Now we lose, the income that we did have from the bar. We lose that. Remember on that first slide, it was 14,000. So we lose that. And so now we're not making as much profit as we did when we had both the bar and the restaurant. So it wouldn't be a good decision to eliminate it. So that was just an example. If something's not allocated properly, it can, it could hurt you because you can make a bad decision on eliminating a segment that maybe you don't need to. So that was about segment and breaking the segments out and the fixed costs and traceable costs. And that was the end of the chapter. So do you have any questions on any of what we went over in the segment section?
No, ma'am.
Okay. All right, so there's a couple of slides in here that I would, go in, maybe clip a copy of it, save it. It could be helpful when you're doing your homework just to refer back to them. How when you're looking at variable costs versus absorption costs and what's coming in, that slide that had, if your production's higher than your sales or your sales is higher than your production, how does that affect your numbers? That slide would be good to hang on to. And that can help you when you're working through the homework assignments. So speaking of homework assignments, does anybody have questions on anything from chapter 5 homework? Okay.
No, ma'am.
All right. So y'all are rolling right along. We're, more than halfway through. And 5 and 6 has a lot of different types of calculations in it. If you do the homeworks and practice, it should be fine when you get to the test. Homework's always a little more, in detail than the questions on the test. We're going to do same format where I'm going to have a study guide up for you. You will have the couple of practice problems to do before the test. There more than likely will be an extra credit to do after. That's going to go towards your exam 3. And that way it can give you a few extra points. And we'll see how we're doing. So we'll have, an extra credit go up that pertains to the exam 2. We'll have one for the exam 3 more than likely. And you still have those homeworks. Remember to, try to get as many points of those homeworks as you can, because that can help your overall score in the end. It'll be another added test grade. So if you have 80% of the homework done, you'll have an 80% that goes into those other 4 tests. You have 100% done, you have 100 going in with the other 4 tests. So try to make sure you do the homeworks. And if you have any questions on any of the material from chapters 5 and 6, go ahead and email me, send me a text if you need me to respond right away. And then again, the test is not going to be next week, it's the following week. So you have quite a bit of time to prepare for this test. And then I'll send an email to let you know about the 26th. And that's all I have. If y'all don't have anything else, that's it. Y'all have a good weekend.
Thank you.
Thank you.
All right, thank you.